What would I do if I had to start investing all over again with just $10,000? Monkey flying money? Sounds like a small amount, right? But if you invest smartly, that small amount can grow into something huge over time. And today, I'm going to show you exactly how I'd allocate that money across stocks, ETFs, dividend-paying investments, and even some cash for flexibility. And yes, even a monkey like me can do it, and so can you. Welcome back to Money Monkey, your smart jungle guide to making your money work while you're busy, well, swinging from trees. Monkey face. If you're new here, this channel is all about teaching beginners, especially those over 40, how to build long-term wealth with ETFs, stocks, and passive income. No hype, no get-rich-quick schemes, no buy this stock and retire tomorrow nonsense, just practical step-by-step advice you can follow. Let's be honest for a second. Most beginners make the same mistakes. They either keep their money in a bank account where inflation slowly eats it like termites chewing through a wooden desk, or they chase random stocks because some internet guru promised overnight riches. And that's exactly why most people stay broke. Now, imagine you're sitting on a pile of cash. You look at it and think, what should I do with this? That's where strategy comes in. The key is to allocate your money into a mix of investments that balance growth, risk, and stability. And that's what I'm going to show you today. First, I would put around $3,000 to $4,000 into an S&P 500 ETF. Now, I know some of you might be thinking, Money Monkey, what's an ETF? And what's the S&P 500? Don't worry, it's simpler than it sounds. The S&P 500 is basically the honor roll of American companies. It includes the top 500 companies in the United States, the ones that have proven over decades that they can survive recessions, inflation, and market crashes. Companies like Microsoft, Google, Amazon, Visa, Costco. Basically, if you see a brand in your kitchen, living room, or on your street, there's a good chance it's on the S&P 500. When you buy one share of an S&P 500 ETF, you're essentially buying tiny pieces of all 500 companies at once. That's diversification. It spreads your risk. And for beginners, diversification is like a safety net in the jungle. You don't want to walk across a rope without one. Personally, I invest in SPRI because it's the most traded ETF in the world. That means high liquidity, easy to sell, and perfect for strategies like covered calls. But if you don't care about that, other ETFs like VOO, IVV, or SPLG are just as solid. SPLG is cheaper per share if SPY feels expensive. Historically, the S&P 500 has returned about 7 to 12% per year on average. Some years it dips, maybe even 20%, but over the long term, it grows steadily. Now here's something most beginners don't realize. The companies in the S&P 500 aren't just big brands. They're resilient businesses that have been tested by recessions, interest rate hikes, oil shocks, and even pandemics. If you invest in them, you're not just betting on one company. You're betting on the backbone of the American economy. That's why index investing is often considered safer than picking individual hot stocks. Next, I would add exposure to technology companies through the Nasdaq 100. If you're younger, or you can handle a bit more risk, you might allocate around $3,000 to this sector. Technology companies are the ones shaping the future. Nvidia, Tesla, Meta, Google, Apple. ETFs like QQQ or QQQM track these top 100 tech-heavy companies. Yes, tech ETFs are volatile. They can go up fast, but they can also dip sharply. But for investors with higher risk tolerance, they are a way to grow faster. And don't worry if you're scared of volatility. You can always adjust the percentage you invest based on your comfort level. The key is to not put all your bananas in one basket or one ETF. And here's a fun fact. Investing in tech ETFs isn't just about getting rich fast. It's about participating in innovation. Every time a company in the Nasdaq 100 invents something new, from AI chips to electric cars, you indirectly benefit. And while some companies fail, the winners often grow exponentially, balancing out the losers in the long run. That's why spreading your risk across a tech ETF is smarter than trying to pick the next Tesla by yourself. Then, there's the boring but beautiful part of investing, dividend-paying ETFs. These ETFs are like the calm, wise old monkeys in the jungle. They don't swing from vine to vine chasing hype, but they survive storms, and they pay you along the way. ETFs like SD include companies like Pepsi, Coca-Cola, Home Depot, and Waste Management. I like dividend ETFs because they give consistent payouts. Last time, I received $241 from a mix of dividends including Waste Management, Lockheed Martin, Meta, Microsoft, Home Depot, MasterCard, Costco, and Lowe's. That might not sound like a fortune, but it's passive income just for holding shares. And over time, these dividends can grow significantly if reinvested. Some beginners avoid dividend ETFs because they don't grow as fast as tech stocks. But remember, investing is about balance. While tech ETFs might give bigger spikes, dividend ETFs offer stability. During market corrections, tech stocks might tumble 20 or 30%, but dividend-paying companies usually hold up much better. They are your safety net, your jungle shelter during storms. Here's another tip about dividend investing. If you reinvest your dividends, you're essentially buying more shares with free money. Over decades, this can create a snowball effect, turning modest portfolios into serious long-term wealth. And the best part? You don't have to stress about timing the market. Just let the dividends pile up. The last thing I would include is cash. I know, some people laugh at me for keeping cash, but it makes me sleep well at night. Having around 5 to 10% of your portfolio in cash gives you flexibility. When the market dips, you can deploy cash to pick up your favorite shares at lower prices. Think of it as keeping bananas in your treehouse to snack on when other monkeys go hungry. And if your brokerage gives interest on uninvested cash like Fidelity, that's an extra bonus. At the time of recording, their money market account yields around 4.9%. So even your sleeping money can earn a little extra while you wait for the right investment opportunity. Now let's break down numbers. Here's how I would allocate $10,000 in a balanced portfolio. $4,000 in an S&P 500 ETF like SPY. $3,000 in a tech-heavy ETF like QQQ. $2,000 in a dividend-paying ETF like SD. $1,000 in cash for flexibility. If you wanted a more conservative approach, you could do something like $4,000 in CY, $1,000 in CY, $1,000 in dividend ETFs. Simple, effective, and beginner-friendly. Here's the important lesson. It's not about timing the market or chasing hype. It's about investing consistently, diversifying wisely, and holding for the long term. Small, disciplined investments grow over time thanks to compound interest. Money makes money, and then that money makes even more money. Kind of like monkeys multiplying in the jungle, but with fewer banana fights. Let me give you a real-world scenario. Imagine you invest $150 every 2 weeks in a combination of S&P 500 and tech ETFs. That's only $300 per month. You stick to it for 20 years. Even if the average return is just 8% per year, you could end up with over $250,000. Not because you were a genius, not because of luck, but because of consistency, time, and the magic of compounding. Another key thing beginners overlook is emotional investing. Markets go up, markets go down. If you panic sell every time there's a dip, you'll never reach your goals. I call it the banana panic. Stay calm, stay invested, and use dips as opportunities to buy more of your favorite companies at lower prices. Also, remember to revisit your portfolio periodically. Rebalancing, adjusting the percentages of your S&P 500, tech, and dividend holdings, helps you maintain your target risk level. It's like trimming the branches in your jungle garden so every plant gets sunlight. Even if you start later in life, it's never too late. With $10,000 and the right strategy, you can set yourself on the path to serious wealth over time. Even small contributions, invested consistently, can turn into a large portfolio in 10, 20, or 30 years. And don't forget tax efficiency. ETFs are generally tax-friendly compared to actively managed funds. That means more of your money stays invested rather than going to taxes, which can make a huge difference over decades. So here's my final advice. Start simple, diversify, reinvest dividends, keep some cash handy, and be patient. Don't panic when the market dips. Don't chase every shiny new stock. Keep swinging along your own investment path. And if a monkey like me can understand investing, you can too. Monkey Face Money Bag. Check out the other videos popping up on your screen right now. I've got guides on building dividend portfolios, picking ETFs, and maximizing passive income. Watch them right after this video, and your future self will thank you. This is Money Monkey, signing off from the jungle. where even the bananas know about compound interest.